Good evening, Reena. Reena, thank you so much for your support, solid support, and willing to give you a very valuable time as a keynote speaker and share your research ideas with our participants. So now I would like to pass this to Elvira to formally introduce you, and then you take over from there. Thank you.
Good morning, everyone. Thank you to this first session of the conference. And we will be running this on, obviously on Zoom, but the questions are running on Slido. So I've put the link of Slido on the chat box. Please click there and type your questions. As and when you have them, I will moderate them for Reena. It's a great pleasure to have Professor Reena Aggarwal today to give our first keynote. Reena is the Robert McDowell Professor of Finance and also Director of the Georgetown Center for Financial Markets and Policy. Reena specializes in global financial markets, capital raising, IPOs, FinTech, institutional investors. So anything you want to know about investors, markets, exchanges, Reena will give you an answer to. Reena has been extremely active in both academia, but also as an administrator, especially at Georgetown, where she's held positions across the value chain of the university. And she has been on the editorial boards of major journals. She is an extremely prolific and highly cited researcher. And she also does a lot of work with outside partners like the IMF, the IFC, and so on. She also is on the board of directors of several companies. So Reena is a very well-known and extremely accomplished researcher, and we are very pleased to have her today to give the keynote talk. Reena, as we discussed earlier, you have 45 minutes, and then we'll have a Q&A session at the end.
Great, Elvira, thank you so much for that very kind introduction. And I really must congratulate Bala and the whole team. It's just really amazing what you put together. And I love the fact that so many different universities have come together and collaborated. I have been involved in this conference. I spoke at it many years ago, and I'm just delighted to be back, even during these challenging COVID times. So let me start by, let me get share the screen here. I hope everybody can see this. So in some ways, this is a two-part presentation. And I guess since I'm starting off, I thought maybe talk a little bit about what are the research issues in corporate governance right now that we're dealing with and that we'll deal with for the next several years. And this is a governance conference broadly, but that's been one of the focuses. And so the last 15 years, I would say, has been about the G. The focus has been on the G. And we've looked at issues, a lot of people on this screen have worked in this area. The first few issues were about, does governance matter, right? If governance matters, then the next set of questions were about, well, what aspects of governance matter? I think the private sector was extremely concerned. You had ISS coming out with a whole list of issues, and you had Glass Lewis coming out with a whole list of issues. And people wanted to know, okay, what do I have to pay attention to? What matters? What doesn't matter? And I've just categorized into broad categories here. What role does the whole voting process play, right? There have been lots of really good papers who have looked at everything from role of institutional investors. I've had some work looking at how governance travels, for example, from one country to another. And so what role do institutional investors play? And some of the questions were about, are they just window dressing or do they really care, right? So this is the past, but I'm mentioning this because I think this is also the future in a different way. Then there were lots of studies related to shareholder activism, hedge funds, proxy contests, and we looked at all those kinds of issues. Executive compensation, again, people like John have done a lot of work in this area. that was another focus of the governance papers in the last few years. The role of board of directors, it was definitely an issue. And again, some of the work I did there was looking at, do votes really matter? If you get negative votes or you don't get support from shareholders, does it really make a difference? And I think the policymakers were really interested in that question also, because it was, do you need regulation or can the market take care of this on its own? And we were finding that these votes really do matter. So if you start getting negative votes as a director, there's going to be higher turnover. You're not going to be appointed to chair important committees, etc. And then there was the issue of international corporate governance, which is kind of a nice framework because you had different countries which had different types of governance. And some of these papers looked at what was happening in that space. A whole set of papers on the political economy of governance and what role that plays. So these are some of the issues that we worked on in the last 15 years. So as I look to the future, and I think particularly, I'd say sitting in Washington, maybe I have a slightly different perspective. And as Elvira mentioned, we have the Center for Financial Markets and Policy. So we are very much working at the intersection of markets and policy, and it shows up in the research that I do also. So I believe that the next 10 years are going to be all about E and S, right? And it's E and S, but it's also overlaid with G, right? So it's not just E and S, but it's E and S overlaid with the G aspect. And so much has happened, especially during the last 2, 3, 4 years, that has really accelerated the attention on E and S. And I'd say that probably there was more attention on the E than the S until the last few years. But with COVID, with movements like the Me Too movement, Black Lives Matter, the S has become extremely important. And there's a lot of interest in the S. One of the things that we keep hearing about, even in the last year and during COVID, has been, so the stock market has continued to perform very well, while we kind of have a disconnect with the broader economy, where lots of people don't have jobs. And so income inequality has become worse. And so again, the S factor is on a lot of people's mind. And as you know, there's renewed discussion about stakeholder capitalism. At Georgetown, we have a very strong ethics group. And I remember having this conversation in the 90s where our faculty were talking about stakeholder capitalism. And then it kind of died away for some time. But as you know, it's very much back on the agenda now, and lots going on in that space. So again, in the next 10 years, it seems to me that there's going to be a lot on the E and S, and the E is important, but the S is really important also. Okay. So what do I mean by the S? Gender and diversity issues, as an example, right? At the corporate level, I know the boards that I sit on, for example, there's really a lot of attention being paid in a number of different ways. One is gender and diversity issues at the firm itself, the employees of the firm. Then there is at the board level. And then whatever company you might be at, your investors are asking, what does gender and diversity look like at your firm? What are you doing to improve gender and diversity at your firm? And in some ways, this also ties up with human capital issues, right? So the regulators started requiring disclosure about human capital issues in terms of compensation, right? So it was the ratio of CEO compensation to worker compensation that now has to be disclosed. And I won't be surprised if more disclosures will be required along these lines of CEO worker compensation, gender diversity, the S factor. More disclosures will be required, more regulation will come in these areas. And COVID has made it very clear, the whole employee engagement. How do you engage employees during this challenging time period that we've had? We've seen that at universities, and the whole communication aspect with your employees has just taken on a whole different role. So in a way, this is really exciting for us as researchers, because there's going to be a lot to do here, right? And I do think there'll be regulation that'll come that that is going to make kind of more data available, more kind of natural experiments that we'll be able to do. So we can certainly see, I have a little more of the US perspective. The SEC is working big time on ESG disclosure. Climate is just across the board, right? From Treasury to EFSA to the banking regulators, the focus on climate risk and the relationship between climate risk and systemic risk. There's a lot of focus on that. The challenge is going to be, and is that you have all these different organizations putting out these ESG scores, and the correlation between these ESG scores tend to be relatively low many times. And so I think companies are struggling with that, and there's an effort to bring about some kind of homogeneous standardization, but at the same time, you can't look at the ESG issues of an oil and gas company the same way that you do for, say, a high-tech company. So there have to be some variation that has to be allowed. So I do think climate is going to be a big one, that regulation is going to come, more disclosure is going to be required, and the regulators are going to go after companies that are not doing enough in these areas. So besides investors, regulators are also really focused on these issues, getting very focused on human capital issues, and that's tied to compensation, for example. As a lot of people know, lot of new proposals being put out there about board diversity as an example, right? And the NASDAQ proposal that's floating around there and has been filed with the SEC, and they are making that, they're making disclosure a requirement for listing. And you don't have to meet it, but if you don't meet it, then you have to provide explanation for why you're not meeting it. California has its laws, then other countries have their laws. So there's a huge, I think, opportunity for research, a research agenda. And these are all new issues. And I think we in academia kind of have both a responsibility and also the luxury, right? We can dig deep into these topics and help both market participants and policymakers understand what's really happening in these spaces. So I think there's going to be a lot for us to be working on in the next 10, 15 years. Then this whole world of SPACs. Oh my God, there are so many corporate governance issues there, right? SPACs have become so popular, but they're huge governance issues. And this is an area ripe for looking into at each step. What are the governance issues? The different parties involved in a SPAC, what are the governance issues? That's going to be really important, I think. And again, regulators have started paying attention to SPACs, and and it'll be interesting to see what they do or don't do. Then there's private capital markets. Obviously we've had private equity and hedge funds in the past. And I think those are also areas, especially with even with the most recent events in the last 2 weeks, where probably more disclosure is going to be required in private capital markets. So most recently, it's even family offices. More disclosure might be required as to what are family offices doing, right? And I'm also thinking about under private capital markets, it's crowdfunding, things like that, right? They are not as regulated as the public markets, but what does that mean? And what does that mean for capital raising? But what does it mean from a governance point of view? And the final one I won't get into, this is a huge area, the area of crypto assets and exchanges. Again, ripe for regulatory action, regulatory guidance as to what's a security, what's not a security, and how these exchanges should be regulated, may be regulated, what happens. So that's kind of another big area. So in some ways, I think we have a lot that's going to keep us busy for a while, and where we can make a huge difference in understanding these issues and studying these issues and educating the markets and educating policymakers. So I think we have our work cut out here. And so that's kind of my broad thinking in terms of where I think ESG issues will be important as we go forward. And so but the next part, I'll focus on private capital markets and get into the specifics of a study that we've been working on private capital markets. And so this is work with Kathleen Handley at Lehigh and Xiao Fei, my colleague at Georgetown. And
before you move to that, there are a few questions in relation to what you just said, so maybe we get those out of the way and then you can talk about private capital markets.
Absolutely.
Okay, so the first one is actually something that I have been wondering for a while and you touched on it because you were mentioning the fact that there are several different aspects that ESG captures. So do you think that it's appropriate to just focus on one index on its own? Or really we should be looking at each of these individually to understand which one is the one that matters? There are trade-offs between them, and sometimes you can't do well on all of them, and it may be easier to do better in one rather than in the other. And so on average you are okay, but you're really lagging on some aspects, right? So that's something maybe you could talk on now or later. And can I just read to you a couple of questions while you think about this? So the first one is, do you agree with Larry Fink at BlackRock, who wants a new model of corporate governance to benefit all stakeholders? Who is researching such models? And again, as major stock exchanges trade their own shares, should companies also try to have full disclosure on the should the exchanges have full disclosure on the identity of each trade?
Okay, let me maybe start off with the ESG question, the first question, Elvira, that you mentioned. So I think that's a real challenge. And as I said, right, it varies from industry to industry. How do you compare an oil and gas company with a tech company, right? I myself am working on a project where we're looking at the holdings of mutual funds, right? And one of the data sources we're using is Sustainalytics, their ESG scores. And then in 2019, they changed their methodology, right? And rightly so, they brought in a lot more factors that goes into their score now in 2019 than what they had for many years before that. And the interesting thing is that the correlation between the old and the new score is not that high, right? And so I think what you have to do is do some kind of a peer analysis and industry controls. And some of this will sort out, right? So there's the World Economic Forum, along with E&Y. They have been working with a number of different organizations like SASB, et cetera, trying to see what can be harmonized, what can we all agree to, rather than having so many different scores available out there, measuring different things. But the one thing I do keep hearing is it's not one size shoe fits all.
Yeah.
So how do we make sure that we allow for different companies to be adjusted differently? I don't know, but I'm guessing that the regulators are going to ask more for disclosure and give some leeway to companies how you want to disclose that information, rather than force companies to disclose only in one way. I think they're going to start with just disclose what is your exposure to risk. The stakeholders discussion is an interesting one, and we've seen our colleagues in academia take different points, different viewpoints on it, and I mean, some people will still believe that by maximizing shareholder wealth, you're actually taking care of stakeholder capitalism. And what exactly does that mean to different people? It's still an open question, but I think the discussion has just changed, where companies have to be responsive, right? If you're not responsive to stakeholders, the challenge is you can't kind of measure it and capture it. And what people worry about is you're going to try and do a little bit of this, but there's no objective measure. And now what's the board going to be accountable for? What's management going to be accountable for? But I think focusing on stakeholders, the train has left the station. Your employees are demanding it. Your shareholders are demanding it. Institutional investors are demanding it. And companies are saying, yeah, we have some role to play in this, right? And how do you balance it? It'll be interesting to see how it plays out eventually.
And then there is a question on SPACs. So do you think the rise of SPACs as a form of raising IPO capital is yet another sign of the disconnect between the real and monetary economy? What sort of governance issues do you think these blank check companies pose?
Let me just address the issue of the disconnect between the real economy and the stock market. I don't think we should expect, for example, the S&P 500 to be reflective of the economy. I mean, it's 500 companies, and even the S&P 500, it's really a few companies that are driving what is happening to that index, right? It's not the restaurant owners, it's not the mom and pop shops. So, we sort of think as though they're completely linked, but they're not. They really are quite different. It's only it's one part of the economy. And then there is a whole other part of the economy that, especially during COVID, was just hurt so much that was not getting reflected. So with respect to SPACs, I mean, the way I see it is like any investment. We've seen IPO bubbles, we've seen the dot-com era happen. It's another way of raising capital, and there'll be some deals that make sense, and there'll be others that don't make sense. And I get asked the question, so will SPACs take over IPOs? I don't know, but I can see that there are different companies that will want to use different ways of raising capital or going public. So I don't think IPOs are going away. So there'll be IPOs, there'll be SPACs, there'll be some direct listings for some companies who don't need the capital. maybe all three will continue to be in existence, and over time, sometimes IPOs will be a lot more popular, at other times SPACs will be more popular.
All right, thank you. Let's go ahead.
Okay, so in this paper, we're looking at a private capital market. And in these private capital markets, you don't have analysts and you don't have sort of the due diligence that's required in public markets from a regulatory point of view and a market structure point of view. So there are these reviewers, and the crowdfunding market is an example of it, and it's starting to be an important source of financing that's available. And what we're looking at in this paper is specifically using ICOs, right? And these are initial coin offerings. It's a type of crowdfunding, and they're not under the purview of regulation like an IPO would be. So there are no formal analysts, research analysts that are associated with an investment bank, or there are no auditors, there are no regulatory filings. It's a little bit like Yelp or other places where people are providing comments about different products that they've used. And we're only using ICOs sort of as an example of a private market. So the question is, how can investors get information in a private market, and what kind of information is useful? Because especially in these private markets, there's so much information asymmetry. And so we use ICOs as just an example of a private market. Right? And so we're trying to look at how do these private markets, how can they get rid of this friction, this information asymmetry? And so there are these voluntary expert reviewers, right? They're voluntary, nobody is paying them. And the question we are trying to answer is, do they serve any role? So who are these experts? ICO Bench is this place that provides a lot of data on ICOs. And basically, I can become an expert if I provide a photo, a bio, a LinkedIn account, and I've got to answer a few questions, and then they will say, fine, you're an expert, and I can start providing reviews. Okay? So it's very easy to become an expert. And here is an example of Jason Hung. Jason is an expert, and he is a top-rated expert. And Jason he's an advisor to tons of ICOs, right? He serves as an advisor to many, many ICOs. And he says he's a serial entrepreneur and inventor in mobile technology, blockchain ecosystem, digital marketing, AI, and so on. He has more than 20 years, proven track record, et cetera, et cetera. He has rated 241 ICOs. Average rating is that he has given is 3.8 on a scale of 5. And his ICOs have done very well. So his ICO success rate that ICO Bench puts out is 96.2. That's why he's amongst the top rated experts. Right? So a lot of them they're associated with other ICOs, they're in the industry, they're in the business. And so the question is, so why does Jason do these reviews, right? And I'll get to that question also. So these reviewers like Jason, they provide a numerical ranking, right? So as we saw in the previous slide, he gave a new numerical rating, and his average rating is 3.8 that he has given to his 241 ICOs. So he gives a numerical rating. And I must say, when we started the project, I thought these numbers would be like really high, great inflation. And the average would be like 4.5 or 4.7 or something like that. But that's not what was happening here. So people like Jason, they provide these numerical ratings. And they also provide textual reviews, right? So these textual reviews are not like analyst reports. They are very short, a couple of sentences. And in our sample, we have more than 8,000 textual reviews, more than about 400 experts. And for an ICO, typically there are 5 experts who provide these reviews. And so in case I don't get to all my slides, which is perfectly all right, here are the questions that we are looking at and the answers that we are, what the results are showing. So the first question was, what motivates a Jason to provide these reviews? He's not being paid for it. Why does he care? And we find that these experts will provide ratings when there are more team members. So the ICO has team members, right? The larger the team, they'll provide more reviews. Right? So it's well known, there are more people involved, there are more connections. And then also something called benchy rating. I'll discuss this a little bit more, but a benchy rating is an algorithmic rating that this platform provides. ICO Bench rates ICOs and provides this algorithmic rating basically. And if you have a higher benching rating, it's likely that more experts are going to provide reviews for these ICOs. And why do they keep providing these ratings? What we find is that if you're more experienced, you've been doing this for a while, it's more likely you'll continue doing it. And the other thing is that if the community is giving you positive feedback, right, then you're likely to do it. So the community can give me likes. I do an ICO rating and the community can give me a like. And that feedback, it keeps me going and I get more likes and then I'm more likely to keep doing these, even though I'm not being paid, but I'm getting this positive feedback and now have experience, I've been doing it for a while. And if I've been doing it for a long time, we're also finding that as experience increases, I tend to be less positive. Right? As you gain experience, you become less positive, you care more about your reputation maybe, and so you're willing to write more negative reviews. And so do these matter in terms of the funds raised? So we're finding, yeah, there is a positive association between the funds raised and these textual reviews. So there is an outcome that is positively related. Right? And if Jason and the other 5 who are providing these ratings on an ICO, if they're all going in the same direction and there's consensus, then more proceeds are likely to be raised. That's another thing we find. I think a very interesting part of our paper is focusing on conflicts of interest. So what are these conflicts of interest? So a Jason, as you saw, he is an advisor on many different ICOs, right? And so one conflict of interest could be, well, this ICO that I'm rating, I know one of the team members, I worked with them in the past, right? The other conflict could be, I want people to hire me in the future. If I say good things about you, maybe you will hire me as an advisor or as a team member. I'll be part of the team if I say good things about you. So there are all kinds of conflict of interest issues here. And we do find that if you have these conflicts, I'll tell you how we measure these conflicts, then I'm more likely to give positive reviews. So these conflicts do exist. But the really interesting thing is that the market understands these conflicts. So if I'm conflicted versus Elvira, you're not conflicted, you give a positive rating and a positive write-up about an ICO, the market listens to you much more than they listen to me. And if someone who's not conflicted gives a positive review, then the funds raised are going to be higher. But somebody like me who's conflicted, the market discounts that, and the funds raised are not higher. So overall, these results are suggesting that, that there is a role for these expert reviewers. I must say, when we went into this, I had no idea how this would come out, that these conflicts could be just terrible and these people are really not providing much use at all. But what we find is these voluntary experts actually, they can play a role, and there's a reputational effect involved, and that keeps them somewhat honest here. Okay. So as I mentioned, we are looking at this data from ICO Bench. That's the data many different studies have used. And the ICO market was very active in 2017, 2018. And after that, the SEC started cracking down. And because of that, then the market went down. So we're looking at this data. Again, the purpose of using ICOs is more of as an example of a private market. And we look at 3 different types of ratings. I mentioned the Benchy rating. This is put out by a third party, ICO Bench. They put out this rating on the quality of an ICO. Then the Jasons of the world, they'll write a numerical, they'll give a numerical number, a number rating, and they'll also provide a textual rating. And then we have all kinds of other controls going on here. So some really large offerings, EOS was a huge offering, more than $4 billion. Telegram was another big offering. And you can see 2018 was a big year, and 2017 was, there was quite a bit of activity. But before that, it was a pretty quiet time for ICOs. So on average, they raise about $17 million, and ICO raises about $17 million. I should say a little bit about white paper link. What is a white paper? In some ways, a white paper, it's not a prospectus, but you might think of it as one. It really describes what is the problem that you're trying to solve with this ICO? What is the project? Who is the team? What funds do you want to raise? What do you want to use the funds for? And almost all the ICOs have a white paper. So 96% have a white paper, and they'll provide a link to investors. Here's our white paper. Okay. Number of team members, they're pretty large teams, relatively 12, 13 team members. And as we saw, you're more likely to be followed by experts if the team is larger. I should mention that these reviews that I'm talking about, these are pre-ICO reviews, right? So they're not after an ICO happens. So think about an IPO, for example. It's not after the offering. It's just before the offering to help you decide, do you want to participate? Do you want to invest in this offering or not? Okay. That's what we are looking at. Right? And these ratings will be provided on 3 different dimensions in addition to sort of the total. So they look at the team, the vision, and the product. And they will address these issues. So here are the average ratings. Again, there's not a huge amount of grade inflation here, right? The averages are in the 3-point-something range. They're not like 4.5, 4.8 for on any dimension here. So we use a textual methodology to read all these reviews, and we use this sentiment analysis that comes out of Stanford, which is more appropriate for short reviews and short sentences rather than the bag of words approach that has been used in the literature for other purposes. Each review, again, this is not like a long research analyst report. This is 70 words on average, 4 or 5 sentences on average. Right? And so we captured the sentiment, overall sentiment. So as you can see, 46% have a positive sentiment. The sentences have a positive sentiment, and almost 50% are not positive. So there's quite a bit of deviation. And as I mentioned, the reviews can get agrees whether people like my review or not. And on average, there are about 2.5 reviews for each reviewer. So Elvira, tell me how much time I have and I can go appropriately.
You still have about 5 minutes.
Okay. So I'll just, touch on the highlights here, right? And let me skip this one. So what determines whether there's a review or not, whether there's a numerical rating or not, whether there's a textual review or not, if there's coverage by experts, and the benchy rating that's provided by the third-party platform. If they give you a high rating, more likely the experts will follow you. As I mentioned before, if the team is of a larger size, you're more likely to be followed. So that's just determinants of reviews, and I will then go on to the next question. So this is, what motivates Jason to keep doing these reviews? He's not getting paid to do them. So why is he getting, why does he want to do it, right? So one thing is that ICO Bench, when they're rating Jason, they are also looking at how many reviews have you done, right? What kind of positive feedback are you getting, right? I want my rating by ICO Bench to be high. If Jason wants his rating to be high, he should keep doing these. And then the positive feedback is helping Jason to feel good, I guess, about doing these reviews. And the more you keep doing, the more likely you're going to continue doing them. So that's the motivation. And so the more experience I have, this is again just saying it in the same different way, the more experienced I am, I've been doing it for a long time, I'll continue doing it. The more positive feedback I get, more likely I'll continue doing reviews in the future. Okay. So then, as I keep doing it, how do my reviews change? Do they change the content of my reviews? And the more I've been doing it, I'm doing more negative sentences. I'm doing less positive sentences, right? So the longer I've been doing it, there is a reputational effect, and I'm going to give less positive reviews. So funds raised, do these reviews, these textual reviews, does it matter? Does it have any impact? It really does have an impact. So if I'm getting positive reviews, I'm raising more funds. Okay? Whichever way you measure it, the numerical ratings are important, but also the textual reviews are important, even after controlling for the numerical ratings. So the market does care, and companies raise more funds. Okay. This is, as I mentioned before, if there's consensus amongst the experts, then even more funds are going to be raised. Okay. So yeah, I think this conflict of interest stuff is really interesting to see how this works. And so ICO Bench will say we have zero tolerance for sales of ratings. You can't rate the ICOs that you participate in yourself. If I'm a team member of this ICO, I obviously can't rate it. You should not give negative reviews to your competitors. You should not bash your competitors. But in spite of all this, as I mentioned, there can be a lot of conflicts. So we kind of look at two kinds of conflicts: direct connection. Direct connection is you're doing an ICO. You have 12 members in your team. And I worked with one of those 12 members in the team. Okay? That's a direct connection. Indirect connection, all the ICOs in our sample, the more connections we had at any point in time, then I have an indirect connection. And so does it matter whether we have these connections? And we find it does. If I have a direct connection, I'm being more positive. I'm being less negative. Okay? So this, and again, this is all these tests are controlling for a lot of things that I haven't gone through, but ICO fixed effects, expert fixed effects, we're controlling for a lot of different things. So this suggests that there is a conflict, and then, so finally we look at, okay, I have a conflict, and what does that mean in terms of proceeds raised? And I think this is really interesting, where, so Elvira has no connections, right? You have no connections and you give positive reviews, more funds will be raised. Okay? I have high connection, okay? And the market doesn't listen to me. Okay? So the funds raised are not associated with my reviews. My reviews, even if they're positive, they don't help. Those who have a low connection, you can see some positive reaction to that. But you know, someone who is really not connected at all, and they're giving positive reviews, the market recognizes these conflicts. So I think that's kind of really interesting. So we're looking at this private market to see how information asymmetry can be resolved. And what we're finding is these reputational concerns for these experts, they help them, they help to keep them honest to some degree. And these reviews do impact the funds that are raised. And the market participants are pretty smart. They can see where there are conflicts versus when there are no conflicts. And so I think we conclude that there is some role for these voluntary reviewers in private markets, and these reviews have some value. I will stop with that.
Thank you, Reena. That's extremely interesting. This the second time I hear this, it was it gets better with time. So it's actually a very fascinating topic. So thank you for that. We have a few questions, and I would like to remind the audience that they can type the questions on slido.com, and they should use the conference event code of FMCG 2021, and please select Plenary Talk by Reena Aggarwal. So there are two groups of questions. Some are related to what you started with, which is the governance issues, and some are related to the paper. So I'll start with the ones more related to the paper, and then I'll go to the more general ones. So there is a question about the market participants and the conflict of interest. So it says it would be interesting to know how market participants can distinguish experts with conflicts of interest with those without conflict. Are there any established indicators? If yes, why there are no reactions to not conflicted experts? Which is, I think, what you got to at the end, but maybe you may want to elaborate a little bit more.
Yeah, you know, that's a good question in terms of how does the market know, right, whether somebody's conflicted or not. My sense is these investors, it's still a relatively small community, and they tend to know each other. At least those people will have some idea if someone is conflicted. But it's a good question. Let me look at it some more to see, yeah, how does the market know? So I can certainly see that some market participants will know.
Right.
But you know, if a retail investor, how will they know? Probably not that easily.
So I have a question, and I was thinking about it as you were presenting the results slide here, where you were talking about the fact that the longer these experts have been doing this, the worse their reviews, not the worse, but the more negative their reviews have got. And I have this feeling that some of it may be related to the fact that the quality of the ICOs themselves may have got worse over time. There was certainly this feeling in the market towards the end of 2019 that anything would go, right? There was just so much cash thrown at the ICO market that, you know, there were a lot of nonsense ICOs coming around. So is there something you can do about that, or condition on the fact that we are further down the time of the ICO timeline, that, you know, it's more related to the quality of the ICOs decreasing than really the participants getting more negative in their evaluations?
Yeah, Elvira, that's a really good point. And we did think about it. And that's why we're controlling for the benchy rating, right? So in some ways, that's a third-party rating that's capturing the quality of the ICO. And to some extent, that's how we're controlling for that.
Okay. You may also want to think a little bit of some form of a time trend or some time fixed effect.
Yeah.
Maybe.
Okay. Yeah. Thank you.
Okay. So now some more general questions. So one person was asking, hang on, because my questions disappeared. All right. Do you think the recent surge in retail trading, something like Robinhood traders, has an adverse impact on corporate governance?
Another interesting research issue. So I was having this discussion with somebody who's really at the leading edge of governance and activism. And his whole point about kind of what's happening with the Robinhood stuff is companies are really concerned about it, because what's happening is there's so much passive investing, right? And these are buy and hold shareholders. So they are not trading. So when you have this retail volume, it can really shake up the market. And from a corporate point of view, companies are really concerned about the volatility in their stock and what's going on. It's sort of an interesting one. On the one hand, certainly the policymakers are thinking about democratization of financial markets and how do you allow retail investors to play a role. But on the other hand, when things get crazy like GameStop and then the retail investors get hurt a lot, what happens? So I don't know how corporate governance, because corporate governance is at the company level, right? So what does the corporate do to manage that, control that?
So I think the question is more in the direction of the large institutional shareholders in general have concerted efforts to make sure that the company, well, at least they try to push the company towards better governance. Now, if you have more touch and go, short-term retail investors, that may change the dynamics between the short and long-term shareholders that basically push the company in a particular governance direction. I think that's where the question is going.
Yeah. So is it more of the trading that is happening on the retail side, or is the ownership structure changing? Right.
That's a good question. I don't know the answer.
If the retail investors are in it sort of for the short haul and it's more trading and churning that's going on, then it's going to be the institutional investors who'll keep playing a role. But if retail ownership goes up, then I can see that even the types of proposals, shareholder proposals that might get on the ballot might start looking different. And I think that's where the S could become even more important, right? The social issues, compensation issues, worker rights issues, the retail investor might want to push for those even more.
Right. There is another question on your early slides by Andrew Linden. And he says that he was struck by one of your slides, which says post financial crisis, calls by scholars pointed to similar issues. So why has the field of corporate governance, corporate finance ignored these calls and has continued to click to agency theory and its research paradigm?
You know, some of it is, it's hard to measure. For example, the stakeholder capitalism, it's a little bit hard to measure some things, right? Even with ESG, even in spite of all the struggles we had with the G literature and the G research, but the E and S are even more difficult to measure and quantify the way we do in finance, certainly empirical corporate finance. And I think we're trying to find ways to sort of broaden, and the broader community expects us to be looking at these bigger picture questions. And it's kind of nice to see that I think finance research is changing. It has changed, especially since the 2008 crisis, the kinds of issues we're looking at, and much more open-minded about our theories, and so change is happening, I think, and I think for the good.
Okay, so given that we are approaching the end, I'll read the last 3 questions and you can take them in whichever order you are more comfortable with. So the first one is by Terry, and Terry is asking that, or he is stating that the appointment of company directors is sometimes called jobs for boys and girls. So can you discuss alternative arrangements where talent and skill is more important than who you know? The second one is by Petco, and Petco really enjoyed your talk, and he's saying, in the post-COVID era, how can one ensure good balance between the market regulation and deregulation? Do we need more transparency in the digital financial markets, and how do we ensure that? And the final one is by Shan, and it's about, should publicly traded companies be described as public when their shares are sometimes not traded in the public sphere, say things like dark pools, where there is no disclosure of the trading information?
Okay, let me
large cross section.
Terry's question, and I'll try to keep my answers brief. I think the network way of finding board members is changing. Okay? So, for example, again, I'll go back to diversity and gender issues. Now, I think boards are hiring companies that specialize, right, in diversity, in gender, to bring board members. And this diversity is not just it's also about skills. I think companies are really looking at that. It's changing very slowly, but it is changing. And the push from regulation or listing requirements will make it change further, I think. Right? So Petco, market regulation, deregulation, it seems to me this pendulum always swings too much in one direction or another. So we've had many years of deregulation, and now they're going to be, it's time for the pendulum to shift. I don't know how you optimize it. I think you optimize it partly by having good academics be involved in the discussion, and you have research-based, data-based, fact-based analysis that is presented to the regulators. So, so hopefully we can balance that a little bit. Public companies, when their shares are traded in dark pools. So I think of public, so there's the trading side, then there's the public company side, which is more about, I have to disclose whatever the SEC requires me to disclose, right? That's kind of what defines a public company. Then there's the trading side. Are dark pools good or bad? That's kind of a whole different discussion, I guess.
Right. Okay, well, a last very broad question has come in from Ramun, which is whether the goal to pursue wealth maximization was wrong from the beginning. I think we don't have time for that. This is worth a whole plenary talk of its own. But thank you, Reena, for a very, very interesting talk. Also a great overview of what is happening in this field. It's a very exciting time to actually be working in these areas. So we really enjoyed your talk, and we'll look forward to the rest of the conference, and I give it back to Bala to instruct us on how we move forward. Thank you, Reena, and thank you everybody for your questions.
Yeah, thank you.
And thank you, Reena, for the exciting talk and telling us these important issues in corporate governance and presenting the papers on the expert reviewers. So thank you so much for your valuable time and supporting us. And also thank you, Elvira, for your continuous support to Doctoral and other universities. So thank you. So thanks again. So we take a small break, then we will join with the second speaker, John. Thank you.
Thank you, Reena.
Thank you, Reena. And sorry, John, I can't hear your talk because Tarun is giving a talk in a parallel event I'm organizing. So we'll hop off and hop on to a different Zoom session. Sorry.
That sounds great. Thanks a lot, Reena. That was really fantastic. Thanks, Avaga.
Yes, it's super interesting, actually. I have a little bit of concerns myself about these indices, right? I am more into the camp where we should dig deeper into each of them separately, probably, just because there is just so much variation across the three different areas and what can be done and how they can be tackled, and they're not all complementary, right? So oil companies may be doing well on one index but not on the other, so the average doesn't make, like, you know, 1/3 on each category is problematic.
So I think we will shortly end the meeting and take a small break and then come back. So I have asked the people who are assisting us, that is more behind the scene running the show, Erika and Mo. So they may be quickly disconnecting us and then we will be reconnecting.